From the opinion pages of the Wall Street Journal, this is Potomac Watch.
Is a revolt brewing against ESG investing? Plus, voters parse Liz Cheney's loss in Wyoming and also the primary results from Alaska. Welcome, I'm Kyle Peterson with the Wall Street Journal. We're joined today by my colleagues, columnists Kim Strassel and Alicia Finley. Let's start with the Journal's editorial on Tuesday under the headline, "The ESG Investing Backlash Arrives." But to lay some of the groundwork, ESG, of course, stands for environmental, social, and governance. And Alicia, can you give us a bit of a sense of what this movement is all about and how it has managed to sneak into the American economy with remarkably little debate or pushback?
This movement, ESG, different people will define it in different ways, and that's part of the problem. But it's really kind of gained momentum over the last decade, and especially in the last few years, as asset managers and other financial institutions have realized that it's actually quite lucrative for them in terms of that they can brand something, or brand an investment, brand a fund, mutual fund, or exchange traded fund as ESG or sustainable and charge higher fees essentially for a similar product that's like an index fund. But it's also grown in tandem with this kind of progressive movement, progressive investing movement that believes that, worker pension funds, foundation endowments could actually help serve social or environmental purpose and achieve these goals that they can't achieve through legislation per se. And I guess a classic case in point of this is the climate, in terms of a lot of these funds are now pushing companies, energy companies in particular, but others, to disclose their climate emissions and to set goals to reduce their climate emissions. Especially there's a movement for net zero in 2050, where asset managers are seeking to require companies to set goals to eliminate all their carbon emissions by the year 2050. There's also a component in which they're also trying to set, quote unquote, human capital rules on these companies. And this would cover the gamut of, requiring men and women to be paid equally, as well as requiring disclosures of the pay gaps between men and women, and increasingly setting gender diversity and racial quotas for corporate boards. That poses obviously constitutional problems when governments do it. But increasingly, these asset managers are voting against companies if they don't put, say, one or two women on a board, or one or two other racial minorities or gender minorities, someone from LGBTQ groups. So in many ways, this is the left trying to end run Congress and state legislatures. And I think you're starting to see a backlash, at least in Congress and the state legislatures, right now more so in the state legislature, as well as the attorneys generals, about these asset managers essentially using worker funds in terms of the pension funds, but also more broadly other, taxpayer dollars to promote these social objectives or cultural objectives.
But those social and cultural objectives, the HR aspects of ESG seem like they're in tension, at least sometimes, with the environmental aspects. And I'll point to a controversy a couple months ago where Tesla, a maker of electric cars, was dropped from an ESG index, and ExxonMobil remained in the ESG index. And I'll read a section of the Wall Street Journal story on this. In an explanation of the move, the index operator said Tesla lagged its peers for a variety of reasons, including its carbon strategy, working conditions, and handling of a regulatory investigation, unquote. And Elon Musk, Tesla founder, his response to this was, ESG is a scam. It has been weaponized by phony social justice warriors. And I understand the point that he is making, Kim, because Tesla makes electric cars, which you would think would be a real high priority on the E side of ESG. But the index people are saying, well, look at the S and look at the G. It becomes pretty opaque pretty fast. And I grant that the index operator probably has some sort of rubric that they're relying on to make these decisions. But if you can tweak the S and the G and the E and make the rubric come out however you want, then what are we really doing here?
Right. The only thing that was missing from that explanation you gave was the words Elon Musk. And of course, he has become a little bit politically of a nuisance nuisance to many on the left, and so they're out to get him. And this is the real problem. What we're talking about here is ESG is just another word for politicized investing. And as you note, Kyle, you can move around the matrix and the rubric, and you can come up with all sorts of justifications. But fundamentally, this is the left having taken hostage or won over a number of the prominent heads of some of these exchange-traded fund groups, other organizations, whether it's BlackRock or others, and then they get them to impose their agenda via the market, the agenda that they can't get through in Congress or elsewhere. And it fundamentally turns capitalism as we know it on its head, in that what we want here is investors loan money to companies on the grounds that they expect them to make a better mousetrap or provide better services, to hire some good employees, to make good products, and then to watch their costs, to make money, make a return, and spread that return back to investors. It's based on the profit motive. This is in turn saying you need to make your investment decisions and take your corporate actions based on the social good that we, the left, and we, the heads of some of these funds, say is the right thing to do. And if you don't, you'll get punished because we'll vote against you, we'll smear you in the press, we'll remove you from our funds, etc. And now we're starting to see some politicians and others, in particular a group of state attorneys general, who are really pushing back on this because their argument is, no, we have a lot of pension money invested with you folks, and you need to be focused on getting us the best financial returns, especially for our retirees.
And just to underline that point, I don't have a problem if any individual investor wants to make those decisions. If they like electric cars and they say, I'm dropping my Tesla investments because I don't like what Tesla is doing on the social side, or frankly, I just don't like Elon Musk, or any other reason. I mean, it's a free country and it's a free economy. The objection is to those kinds of choices being imposed on people who are not consciously making that decision, who are not choosing to maybe accept a lower financial return in exchange for a clean conscience on whatever your issue of the day is, whether it's people who have money in these pension funds. The other thing, Alicia, is that it seems like these options of ESG are also starting to make their way into the regulatory arena where the government is going to try to impose them. And one thing to keep an eye on is this Securities and Exchange Commission's plan to mandate disclosure of climate risks. Can you give us a sense of what the plan is, what's going on there?
So this is a rule that was proposed in March, but has been long in the works. It actually goes back to the Obama administration considered this, but decided that it didn't have the legal authority because Congress didn't give it. This rulemaking that Gensler, the chairman, has proposed would require companies across the economy to disclose their carbon emissions. I mean, that's the main part of it. But this would not just be limited to the carbon emissions that they produce. It could potentially be also include the what are known as Scope 3 emissions. And that would cover the companies or suppliers and their customers. So for instance, ExxonMobil disclosures wouldn't only cover how much it produces in, refining or oil and gas production. These Scope 3 emissions would also incorporate how much CO2 is emitted when, people drive cars that burn Exxon's oil. It would also potentially include the plastic, how much CO2 is created when Exxon's liquefied natural gas, or rather natural gas liquids, are burned or used in plastics, and then how much is emitted when it degrades in the ground over decades. The broader problem with this is it also imposes liabilities on these companies, and which is why many companies are really pushing back. It's one thing for maybe perhaps some companies to be required to disclose, well, maybe they have a climate risk, or there's a risk if the government imposes a carbon tax, because that could increase their costs, and that would maybe be considered a material disclosure. But it's another thing for them to have to, or government requiring these companies, again, across the economy, to disclose their greenhouse gas emissions and quote unquote climate risk from potential government policies, regardless of whether it really is material to their own business. And just to take an example, an asset manager was telling me the other day, or was trying to argue, that Walmart's emissions are material because a customer in 10 years might step into a a store and say that they want to know what Walmart's greenhouse gas emissions are. I'm very skeptical of that, and I think that is one of the reasons why this is going to be the rule will be especially legally vulnerable to a challenge, is because it's so sweeping and isn't very narrowly tailored. The other reason, of course, that it could be subject to legal challenge is that Congress never explicitly granted this authority to regulate these disclosures. The Congress has granted SEC broad authority to issue rules that are in the public interest or in terms of capital formation and capital efficiency. And this is what the SEC is citing to force through this rule. But in that case, then the SEC can require the government or require companies to disclose almost anything, which also presents free or First Amendment issues here. One other thing I just want to circle back on, and there's a certain irony here. So the asset managers are pushing these SEC disclosures and actually supportive of them. But now the Genslers actually also proposed a new rule that would require them to issue disclosures whenever they name a ESG fund or a sustainable fund, and it would foist all kinds of new reporting requirements and liabilities on these now asset managers. And so there's a kind of a regulation for thee but not me component of this, where asset managers want to foist more regulations on other companies but want to dodge them themselves.